Most retirement income plans look great on a spreadsheet. Then real life shows up. Yields drop, markets dip, the monthly check you were counting on gets smaller, and once you start selling shares to cover the difference, the math works against you fast. That is the part nobody shows you, and that is exactly what this video is about. By the end of this, you are going to know how to turn $480,000 into over $6,300 a month in retirement income. You are going to see the 3 specific ETFs, the real yields as of right now, the tax math for 2026, and the one test I run on every plan to make sure it does not fall apart in year 3. Here's the part most people miss. The income is only half the equation. What matters is whether it lasts. I will show you how to check that too. Quick note, I am not a financial advisor or a government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. If you are within a few years of retirement, the questions have changed. It's not about how much you're saving anymore. It's about whether what you have saved is actually enough to pay you every single month once the paycheck stops. That's the question this video answers. So here's where we start. Social Security. The Social Security Administration says the average retired worker gets about $2,084 a month in 2026. For a couple where both spouses worked, the combined average is about $3,200. But if both spouses had solid careers, that number often lands closer to $3,300. Now, say you're 60, you've been saving for decades, and you've got $480,000. Your combined Social Security will be about $3,300 a month. So what's the gap? If your target is $5,000 a month, you need $1,700 more. If your target is $6,000, you need $2,700. Those are not impossible numbers, but you cannot get there with a savings account. You need your money working for you, and the way you fill that gap determines whether this plan holds up for 3 years or 30. Here's how smart people approaching retirement are building their income. Not with one fund, with 3, and each one has a specific job. The first is SCHD, the Schwab U.S. Dividend Equity ETF. Right now it yields about 3.1%. That's not a high number, but here's why it matters. SCHD holds quality companies that have raised their dividends consistently. Over the past 5 years, its dividend growth has averaged roughly 9% a year, and its expense ratio is 0.06%, almost nothing. Think of SCHD as the anchor. It doesn't pay you the most today, but every year it pays you more, and the dividends are classified as qualified, which means they get taxed at the lowest rate. I will show you exactly how low in a few minutes. The second fund is JEPI, the JP Morgan Equity Premium Income ETF. It yields about 7.9% right now and pays monthly. JEPI generates income by selling options on large-cap stocks. Those are called equity-linked notes. The monthly cash is real, but there's a trade-off. The income gets taxed as ordinary income, not at the lower qualified rate. And in strong bull markets, JEPI tends to lag the S&P 500 because the options cap your upside. Its expense ratio is 0.35%. The third fund is SPYI, the NEOS S&P 500 High Income ETF. It yields about 11.8% and also pays monthly. Now, before you look at that number and think it's too good to be true, let me explain why it's different. SPYI uses S&P 500 options that qualify for something called Section 1256 tax treatment. That means gains get a blended rate, 60% long-term, 40% short-term, regardless of holding period. And here's the key detail. About 95% of SPYI's distributions have been classified as return of capital. Return of capital means you're not taxed on that income in the year you receive it, but it reduces your cost basis. So when you eventually sell, you owe tax on a larger gain. It's tax deferred, but not tax free. SPYI's expense ratio is 0.68%, higher than the other two. So let me put the blend together. Say you split your $480,000 equally, $160,000 in each fund.
Add it up, $36,480 a year from dividends. That is about $3,040 a month at a blended yield of roughly 7.5%. Now add your $3,300 in Social Security. That is $6,340 a month, and you have not sold a single share. Now, would you rather have your dividends grow 9% a year with SCHD or get paid 12% right now with SPYI? That is not a trick question. The answer depends on where you are, but for most people approaching retirement, the blend is the move, growth and income together. So the income works on paper, but here's the question you should be asking. Does it last? Because I have seen a lot of high-yield plans that look beautiful in year 1 and start breaking down by year 3. Let me show you what separates a durable plan from a fragile one. Here's the myth. A high yield means high income forever. Here's the truth. A yield is only as good as the principal behind it. If a fund pays you 12% but its share price drops 5% a year, your income is shrinking even though the yield percentage stays the same. That's called NAV erosion, and it's the silent killer of retirement income plans. So let me run the durability test on each of these 3 funds. SCHD. As of mid-2026, the share price is near all-time highs. The fund has shown 0 NAV erosion since inception. The dividend has grown almost every year. This is the most durable piece of the portfolio. It's not flashy, but it's built to last. JEPI. This one deserves honest scrutiny. JEPI's monthly distributions have ranged from about 33 cents to 54 cents per share over the past year. That's a swing of more than 60%. So your income is not a flat line. It moves. However, JEPI's NAV has held up since its 2020 launch. The share price has not eroded. The real cost of JEPI isn't NAV erosion, it's opportunity cost. In a strong bull market, JEPI captured only about 47% of the S&P 500's upside in 2025. That's the price of the income. You're giving up some growth for the monthly cash. SPYI. This is the one most people worry about. A 12% yield should raise questions. Here's what I found. SPYI's NAV has actually increased since its 2022 launch. The share price is up about 17% over the past year. But remember, 95% of those distributions are return of capital. The real economic yield from premiums and dividends is closer to 4 to 6%. The rest is a managed return of your own money with tax deferral. That doesn't make it bad, but when volatility drops and option premiums shrink, the distribution could decline. It's an income tool, not a growth engine. So here's how the blend protects you. SCHD is your floor. It grows. JEPI gives monthly cash flow with low volatility. SPYI adds the high yield boost with tax advantages. No single piece carries the whole weight. That's the point. I think the 4% withdrawal rule has been the most expensive piece of advice in retirement planning. It forces you to sell shares to pay your bills. Dividends let you keep every share intact and live on the income they produce. The difference over 20 years is enormous. Quick question before we move on. Are you building your dividend portfolio before retirement, or are you already living off dividends? Drop it in the comments. I read every single one. Now, the income works, the durability checks out, but there's one more layer to this plan, and honestly, this is the part that turned a good plan into something that surprised even me. Before I show you the tax math, take a guess. On roughly $60,000 of retirement income, how much do you think you would owe the IRS? Most people say $8,000 to $10,000. The real answer is almost nothing. Here's why. In 2026, a married couple filing jointly gets a standard deduction of $32,200. If both spouses are 65 or older, they each get an additional deduction of $1,650. That adds $3,300 for the couple. But here's the new one. The One Big Beautiful Bill Act created a temporary bonus deduction for anyone 65 or older. It's $6,000 per person. For a couple, that's $12,000. This stacks on top of everything else. So let me add it up. Standard deduction, $32,200. Additional senior deduction, $3,300. Senior bonus deduction, $12,000.
Total, $47,500 in deductions. Now your total income is about $60,000 a year, Social Security plus dividends. After those deductions, your taxable income drops to roughly $12,500. At that level, qualified dividends from SCHD are taxed at 0%. The 0% rate applies to married couples with taxable income under $98,900. JEPI's income is taxed as ordinary income, but at that low taxable income level, you are in the 10% bracket on most of it. And SPYI's distributions are mostly return of capital, so they are not taxed in the current year at all. Your effective federal tax rate on $60,000 of income, roughly 1 to 2%. That could mean a federal tax bill under $700. And if you live in one of the 9 states with no state income tax, Florida, Texas, Nevada, Tennessee, Wyoming, Alaska, South Dakota, Washington, or New Hampshire, your state tax is 0. But here's the catch. This senior bonus deduction is temporary. It covers tax years 2025 through 2028. After that, it could disappear unless Congress renews it. The window is open right now. It will not stay open forever. If you have a parent or friend over 65 who doesn't know about this deduction, share this video with them right now. It could change how they plan the next 3 years. So let me put it all together. Here's the complete picture. Your savings, $480,000, split equally across 3 ETFs. SCHD for dividend growth and stability, JEPI for monthly income with low volatility, SPYI for high yield with tax-efficient return of capital. The blended yield is about 7.5%. That produces roughly $3,000 a month in dividend income. Your Social Security, about $3,300 a month for the couple. Combined monthly income, over $6,300 without selling a single share. Your 2026 federal tax, under $700 on the full $60,000 because the standard deduction, the senior deduction, and the new bonus deduction shield almost all of it. And here's the final piece. If you hold this portfolio for the rest of your life and pass it to your children, something remarkable happens. Your heirs receive what is called a stepped-up cost basis. That means all the gains that built up over the years get reset to the current market value. Your children could sell every share the next day and owe 0 capital gains tax on the growth that happened during your lifetime. Under current law, estates up to $15 million are exempt from federal estate tax. A plan that lasts is worth more than a plan that pays the most. Build the income, test the durability, take the tax break while it's here, and let the rest pass. That's the blueprint. If someone you know is working toward retirement or wondering whether their savings are enough, share this video with them right now. It might change how they think about the next chapter. Tell me in the comments, what is your target monthly retirement income? And after seeing this math, are you closer to it than you thought? If you want to stay ahead of the tax changes, the ETF shifts, and the strategies that protect your income, subscribe to Golden Goals. I cover everything that matters for your retirement.